Welcome for today's session. Today, in continuation of the scope of businesses, we will today look at the forms of business ownership. Forms of business ownership. And with the forms of business ownership, in this chapter we are going to look at the different forms of business ownership, which we categorize into three: sole proprietorship, partnership, and corporation. The objectives. At the end of this chapter, you should be able to identify the various forms of business ownership, describe the various forms of business ownership, and know their advantages and disadvantages. Please, you should take note. If I asked you, or if we are discussing the advantages and disadvantages, is the same thing as the limitation. We will look at the limitation of businesses, advantages and disadvantages, or the limitations. We continue with the forms of business ownership. We are going to look at the different forms of business ownership. When we talk about ownership, ownership is a legal relationship between a person and some object. It is the form of business ownership that determines the sharing of profits, the responsibility for debts, the responsibility for illegal activities, and all similar questions. It is therefore very important that one has a full knowledge of the various forms of business ownership and their implications. There are three major forms of business organization, or three basic patterns of business ownership. They are sole proprietorship, which commonly is being referred to as a one-man business. 2. Partnership or joint ownership by two or more persons. 3. Corporation or stakeholder forms of ownership, which is characterized by, again, the different types of ownership. The selection of a particular form of organization or ownership involves a number of considerations. Some of these are: A. Availability of capital needed. B. Range of ability and experience required. C. Ease or difficulty of organization. D. Degree of personal interest and control desire. E. Distribution of profit. F. Ease or difficulty of transfer of ownership. G. Potential for expansion. H. Tax position. I. Extent of liability for the firm's debt. And J. Stability of existence of the firm. There is no one best form of ownership. The ownership form or structure of each new firm should be selected on the basis of the peculiarity or peculiar needs of that firm. Let's start by looking at the proprietorship or sole proprietorship. Proprietorship is a business concern that is owned by one person and typically operated by him. It is the oldest and simplest form of business organization. In Nigeria, there are more proprietorship than any other form of business ownership. You have examples of so many sole proprietor businesses owned by one person. You have the bookers, the barber shop, retail shop, dry cleaning, house painting, and so on and so forth. And as the name implies, sole proprietorship, it means it is owned by one person. When we say it is owned by one person, it means it is that person that provides the risk capital. The capital needed to start the business. The capital needed to start the business. The advantages of a sole proprietorship include the following. A. Can be established quickly and easily with very little cost. There are no organization fees, and the advices of lawyers to draw up terms are not generally required. B. A proprietor is subject to very few government regulations. C. He retains all the profits for personal use, for reinvestment in the business, for investment in the business. D. He determines the firm's policies and goals and work towards them. E. He has full responsibility for management decision. F. He is free and literally his own boss, but must at the same time continue to satisfy his own customers. G. His operating red tape, such as tax forms and subsequent legal and accounting fees, are held to a minimum. H. Proprietorship can be liquidated as easily as it began. That is, you can stop business anytime. All his assets, liabilities, and receivables are still his. But remember, once you stop business, your like we are coming to see in the disadvantages, your liability is unlimited. That is, you must clear all your liabilities. So what are the disadvantages of the proprietorship? 1. Limited financial resources. Probably the greatest single cause of the individual proprietorship form is the desire for expansion and the resultant additional capital funds. Unfortunately, his financial resources are always limited. Deficiency in judgment or ability. C. Unlimited liability. That is, business debts are personal debts, and if the business assets are not sufficient to cover the claims against the business, the personal property of the owner can be taken to satisfy this claim. D. Uncertain survival. The life of the business ends when the life of the owner ends. The heirs can take over the business, but this is going to be legally a new business with new owners, with some form of legal steps taken before the business becomes theirs. E. Restriction upon freedom. In many instances, individuals that have started their own business largely because they sought the advantages or the independence of action and personal freedom in directing their own affairs, they gradually entered into certain contractual obligations which rapidly limit their freedom. And it is based on such limitations or disadvantages of sole proprietorship that people now think of partnership. Partnership, as the name implies, partners pulling resources together, people pulling resources together to become co-owners of a business with the purpose of making a profit. Therefore, a partnership is an association of two or more persons to carry on as co-owners of a business for profit. They also share their losses that arise from such a business. Partnership may be formed because it is a means of bringing into business more capital or more skills that can be used for expansion. Take note, you need additional money that you can alone provide. You may get somebody with like mind or people with like mind to contribute money, bringing about more capital. Or you bring in other people with different skills that will assist in managing your business. It also serves as a means of spreading the risk of loss among several persons. Usually, each partner, regardless of the size of his investment, receives one vote in matters of control. if nothing is said to the contrary. Profits and losses are also shared equally, but in some cases, defining ratios or percentage shares in profits and losses are established for each partner. Remember, if nothing is said, it's one man, one vote, and you share equally. But at the take-off stage, you may decide to define the ratio or what? Percentage of shares in profits and losses. The share of a partner in profits and losses need to be in same ratio as the proportion of his investment to the total business. Articles of partnership, always very important in order to avoid misunderstanding and disagreement among co-owners regarding their relationships. It is important, although not always legally required, that they be set down in writing when the partnership is formed. This written agreement is called the Article of Partnership. Among other things, it contains the name of the firm, the names of the partners, the place of business, the description of the nature of business, the amount of capital that each partner is to contribute, the method of sharing profits and losses, of course, along with the compensation. If any of the partners are to receive free services or other arrangement concerning withdrawals or addition in investment and limitation of liability, all such must be included in the agreement. Once each partner has signed the instrument, it serves as a legally enforceable contract. Advantages of partnership. The advantages include the following. A, ease of formation. Like with the single enterprise or sole proprietorship, partnership is fairly easy to organize. There are few governmental regulations governing the formation of partnership. B, combined abilities and skills. The resources and abilities of a single individual are limited. In partnership, various skills are pooled towards an effective running of the business, since each does what he knows best to do, and there can be that level of what? Specialization. C, greater financial resources. We discover with partnership, it permits the pooling of capital funds. It is a convenient way of uniting the interests of persons who have capital to invest and would like to enter the same line of business. D, joint decision making. Decision making is joint, and therefore problem solving is based on more input. E, tax advantage. Partnership enjoys tax advantages. From a legal standpoint, this type of firm is not recognized as an organization having an entity or existence separate from its owners. Like we're coming to say, one of the greatest advantage of forming a company is to now distinguish ownership from control. But then what are the disadvantages of partnership? The disadvantages include the following. A, danger of friction and disagreement. Partnership cannot function in the face of friction, mistrust, and constant stubbornness. It is therefore important that personalities or viewpoints of the individual partners be in generally compatible. That's why we always say try to get like minds to agree on doing something. Like minds. If you don't have like minds, it will be difficult for you to run the business successfully. C, restriction on sale of interest. There is always difficulty in effecting transfer of ownership. The interest of operation is not transferable without the consent of all other partners. all other partners. D, risk of mandatory dissolution. If for any reason one of the partners seeks to withdraw or a new member is to be admitted, the agreement governing the relationship among existing partners must be replaced with a new contract. Classes of partners. The classes of partners include A, general partners, B, special partners, C, dormant or secret partners, D, senior partners, and of course E, junior partners. What are they? General partner. A general partner has unlimited liability and may be solely responsible for the debt of the partnership, unless where it is clearly stated all partners are considered general partners. Special partners. Not all partners are exposed to unlimited liability, but at least one must. It is always necessary to file a limited partnership agreement with the set of the person doing business with the firm. Impliedly, a special partner may only be interested in contributing his own money, and he is special because he doesn't bear the risks of the business. Dormant or secret or silent partner. This is a partner whose association with the firm is known to outsiders. It's not known to outsiders. He has no say in the management of the firm. In the event his association with a firm is discovered, he can be treated as a general partner by the law. Senior partners. Senior partners are the original founders or active leaders. Junior partners. These are newer members or those assigned a subordinated role involving smaller investment and corresponding to lower shares. Very importantly now, the corporation. Nigeria have more or less, and the most important in terms of sales volume, number of employees, wages paid, and physical property owned. Corporations are legal entities. They have legal existence separate from their owners. Corporations can sue and be sued in their own manner, may become parties to a contract, and may be subject as individual taxes levied against the business. Ownership is represented by shares of stock, and that is why in corporation we have what we call shareholders. Characteristics of corporation. We find that the policy of a corporation is decided by what we call board of directors, who are elected by the stakeholders at an annual meeting. Because the corporation is a legal person and not a living one, it can daily through the directors, it operates daily through the directors elected by the stakeholders. B, each stakeholder has many votes as the number of voting shares. C, each stakeholder has limited liabilities. D, dividends which must be declared by the board of directors are paid to the shareholders in proportion, or stockholders in proportion to the number of shares held by each. E, legal forms and red tape must be foreseen in operating the corporation. Income and other taxes will be paid at higher rate than those of proprietorship. But what are the advantages of corporation? Limited liability. Impliedly, liability is limited to one's investment in share of stock. Then there's continuity. The operation of a corporation are not legally interrupted by the death, disability, or disappearance of a stakeholders. C, ease in raising additional capital. Corporation can always sell more shares of stock or sell bonds to raise additional capital. D, ease of transfer of ownership. If an owner wishes to sell his or her share of ownership, the shares are easily transferable. E. Legal protection for owners. Under law, a corporation is considered as a legal person. It is therefore separate and distinct from its owners. F. No managerial responsibilities. Investors in a corporation do not have to partake in management of the company. Management is delegated to others. D. Adaptability. The corporation form is adaptable to small, medium, and large size companies. H. Flexibility. Corporation can be more flexible, can more readily hire managers with specialized skills than other form of businesses. Of course, there are disadvantages of forming a corporation. A corporation has more kinds of taxes to file and pay. That's number one disadvantage. Numerous states and federal controls. C. Organizing a corporation is more difficult and more expensive. It requires the services of lawyers. D. Corporate activities may possibly be limited by charter restriction. The articles of incorporation always contain certain specified types of business corporation. Relationship between management and employees, as well as between non-management stakeholder, is sometimes difficult to maintain. And of course, very importantly, a corporation suffers what we call double taxation. Because the corporation is a legal person, it pays income tax on its net profit before the balance is distributed to the shareholders as dividends. Despite the fact that an income tax has already been paid on this money, the individual stakeholders must also pay tax on what he received. This is a form of double taxation. Now, clearly look at ownership. Discuss the different types of ownership. 3. What makes proprietorship the most desirable form of business ownership in Nigeria? And then 4. What makes the limited partnership form of ownership somehow unpopular? Once again, thank you very much for your wonderful listening time. Thank you.